People buy insurance for everything these days: their cell phone, their laptop, appliances, and their home. But where
It's
do you
like you
draw?
can't even go through a line where you've just bought something, and have the register person say, "Yo, you want to buy insurance for that?"
Oh, it's like half of Best Buy's business model, right? It's selling insurance on their gadgets and electronics. So where do you draw the line between protection versus lining the pockets of insurance executives and corporations, right? Welcome to the Bucks Outside the Box show, where we challenge conventional money advice and we get a little contrarian and try to think outside the box, right? So the way that you should think about insurance companies is like casinos. The house always wins in the long haul, right? You might come out ahead in one instance, right? In one hand of blackjack or whatever, in one insurance claim, but over the long term, the house always wins. That is absolutely positively true with insurance companies, or else they wouldn't be in business, just like casinos, right? So what you want to do here is you want to think of insurance as, what is the minimum insurance I need to be protected from, massive risk,
Right.
ruinous risk. So you're not trying to protect yourself from annoyances or irritations like breaking your cell phone. For a middle class person, breaking your cell phone is it's an annoyance, it's an irritation. You might have to shell out a few $100, or maybe $1,000 if you're buying like the flagship top of the line phone. It's an annoying. It might ruin your day, right? You're gonna complain about it to your spouse over dinner, right, or to your buddy over at happy hour, but it's not going to ruin your life. If your home burns down and you lose everything in it, and that's not insured, that could ruin your life, right? I mean, like that's a ruinous event.
I had that happen.
Well, hopefully
And
not without insurance.
well, I was renting at the time, and I was young and dumb and didn't know nothing about renters insurance, which is, I believe, important renting or buying or owning. And my father said, "Why don't you need to have that?" And literally got it 2 months before I had a fire and we lost
Oh wow,
everything.
wow, yeah. So there are some types of insurance that you need insurance against low probability but high severity risk.
Right.
I'm going to keep using that term, ruinous risk, because I think that's really the bottom line here is how you want to think about that. So what you don't want to do is blow money paying for insurance premiums for things like a cracked phone screen or an appliance repair or extended warranties on your gadgets or minor fender benders for your car, right? You don't need ultra low deductible car insurance that's going to fix a $500 fender bump, right? What you instead need insurance for is that low probability, high severity, like ruinous risk, like a lawsuit that could completely wipe out all of your assets, right? And put you back to square one. A house fire that takes your home with it and every single thing you own in this world. A catastrophic medical event, right? Getting a cancer diagnosis that to treat is going to cost $200,000, right?
Right.
Mean, these are ruinous financial events. Or if you have one breadwinner in your family, like the loss of their ability to earn money, especially if the other spouse does not have marketable skills that they can go earn a close to a replacement income on, right? So, these are some of the really disastrous risks that you need to insure against. But even then, you need like disaster insurance, that high deductible insurance. You don't need,
Right.
like, you need car insurance. You don't need car insurance to cover that couple $100, bump in your fender, right? Like we talked about. And that is sort of the dichotomy here. So for the smaller issues, the smaller losses that are inevitable, right? We're all going to break our phones sometimes, right? Self-insure against that stuff. So you want to build up your own assets that you can dip into if you need to cover the occasional thing that goes wrong, right? The inevitable minor annoyance that goes wrong. That can come out of your emergency savings. It can come out of, you can, if you have to sell off, one share of stock or something to cover something like that, it's not the end of the world. But you're saving money on totally unnecessary insurance, and you're investing that money to earn a return on it. So you will come out ahead mathematically in the long term by avoiding these sort of like low end, like rip off insurance policies.
Right. Where
Um,
you're gambling, like you mentioned early, whether something might or might not happen.
exactly. So self-insure against that stuff. Build up your own assets that can protect you from those minor annoyances in life that do come along sometimes, right? Sooner or later, you're going to have to fix an appliance or something, right? I mean, hopefully way later, but that stuff happens. You can come out of your savings for that. You don't have to pay an insurance corporation and line their profits to do that, to pay for that. So, aim for, relatively high deductible auto insurance policies, for example. Health is person to person, depending on what you need and what you want. But, consider higher deductible policies. Same thing for homeowners insurance, higher deductible policies. You don't need the policy to pay out for like, a few $100s worth of wind damage to your house, right? What you need that home insurance for is if a fire burns down your whole house,
Right.
So, yeah, focus on the higher deductible, lower premium policies that still protect you from true disasters that could ruin your finances and maybe for life, right? Set you back, you know, indefinitely in your life financially. But every dollar that you spend over insuring against these like tiny little annoyance risks, that's money that's not compounding for you, as not building wealth for you in the long term. So there's two questions that you should ask before buying any insurance policy. Number one, if this event happens, does it permanently change my financial trajectory? Right?
So if you drop your phone on the floor and it cracks the screen,
Will that permanently ruin your financial trajectory in life? And then, second question, could I comfortably write a check for this risk if it happens without destabilizing my life? Right? These are two questions. These are the lens that you want to look at insurance decisions through. And over time, having some lower premium, higher deductible policies, and less of them, right? So not going out and buying those phone insurance policies. This will leave you creating these more disciplined, larger reserves of capital, both in savings you can just pull out on a dime's notice, but also investments that are growing more aggressively in the long term. And as a final thought here, the goal is not zero risk in life, right? Like the goal is not walking around the world wrapped in bubble wrap. The goal is survivable risk. So,
so like you don't want to be an overprotective parent. You don't want to be an overprotective insured person.
that is exactly the right analogy. It's the exact same thing. So you want to protect yourself against risk that could wipe you out and just absorb those minor annoyances that happen inevitably in life and invest the difference. That's the other important thing here is self-insuring, right? Like, so don't go spend that savings on like the latest video game, right? Or the next clutch purse or, whatever. Like go put that towards your savings and investments and self-insure it that way. And you will come out ahead in the long term instead of the insurance executive coming out ahead in the long term. Deni, any points you want to add before we call this episode complete?
No, I just think it's interesting how often we are pushed to purchase these things. And it is, they make it sound to you like, oh, you need this, this could happen or that could happen. And we really, really have to be kind of calm when we're doing these things and not fall for those things.
Oh yeah, I mean, insurance ads are all about trying to scare you into buying more insurance, right? So resist that urge.
Yeah.
Resist the scare tactics here. All right, guys, if you got a fresh perspective out of this episode, please subscribe to the show. More awesomeness every week. Pay it forward. Pass it along to a friend, family member who might get something out of this. And lastly, consider joining our co-investing club. We meet every month, sometimes twice a month, to vet new passive real estate investments together, aiming for returns in the mid-teens or higher. And if you are not familiar with how passive real estate investments work, things like private partnerships and syndications and private notes, we have a free course on that because most people aren't familiar with that, coming out of high school, coming out of college, coming out of grad school. Sparkrental.com/free, 8 episodes. They're all like 5 to 10 minutes a piece, super quick and punchy. On that note, stay weird, unconventional investor.